Afternoon from Oanda, Asia, in this week's Market Insights video. The subject of most of the video today will be cryptocurrencies, and I'm not wearing a tie today so that I feel young and hip enough to talk about it. If we look at the crypto space, particularly today, it's been a torrid session. Cryptos have fallen quite aggressively over the last week, but it's been a bit of a meltdown today. We look at Ethereum's chart. We can see that Ethereum is down 12% in Asia and is just above the $3,000 mark. If we move over to Elon Musk's favorite little coin, Dogecoin, we can see it too is down around 12.5%. Although I must say the formation that it's tracing out is more of a compressing triangle, and thus if it was to move above 50 cents again, something I think is unlikely, it would likely extend that rally. If it falls below 38 cents, it is going to continue falling. We move through to the center of the crypto universe, Bitcoin. It is down 7% as I speak, trading around $40,300 of US fiat currency per Bitcoin. It has actually traded below the key $40,000 level this afternoon, trading as low as $38,500. 40,000 is a key level for Bitcoin and really will be an intraday pivot point because it is also where the 200-day moving average lies. To be honest, if we close below 40,000 tonight, that will imply that we are going to see a much more extended sell-off in Bitcoin, and the technical target for that is around 28,000. I will note, though, that the relative strength index, which is that box at the bottom of the charts, has moved into oversold territory, and no matter what your opinion is of Bitcoin, etc., Bitcoin could actually rally temporarily because of that oversold condition. So there's some hope out there for some of you. So why are cryptos under such a lot of pressure? Well, the main reason comes from overnight, where the People's Bank of China and some associated entities with it have come out and officially banned financial institutions in China from transacting or pricing any services or products in cryptocurrencies, virtual currencies. Now that story didn't get a lot of traction overnight, but when it got picked up by Reuters this morning in Asia, it should, and we've seen cryptos taking a bath ever since. So, what is the outlook for crypto? What is the threats for crypto? Some say it's a hedge for inflation, some say it's a store of wealth, some say it's the future, some say it's not the future. I don't think anything matters in this particular case. The main issue with crypto now is that after the Colonial Pipeline ransom was paid in Bitcoin, it is now poked a stick at a sleeping bear, and I feel going forward that the main threat to the crypto universe in totality will be regulation. We've seen some shots fired across the board from China, and I have a feeling that we're going to see some more action coming now after the Colonial Pipeline saga from US authorities and or politicians, and that action may be repeated around the world. To be honest, the price action and the behavior in the crypto universe has looked it's looked like a Roman orgy that Caligula would be happy with. Such has been the Wild West nature of it. And I believe right now, regulation is the main threat. And if you are a crypto trader or investor, you should be watching those developments in that space very, very closely. So where is that crypto selling going? Well, some of it, I believe, is going to gold. Gold's had a mighty rally this week. It's trading around $1,869. As viewers will know, I've stated that I felt that gold had traced a cyclical low in prices below 1,700 some time ago. It now looks poised to test 1,900, and I think that can happen. But first, if we look at that box at the bottom of the charts, we can see the RSI is overbought. It is vulnerable to a short-term pullback, perhaps as far as $1,840. But as long as it holds above $1,800, I believe that gold is destined for higher levels yet, and we should see a test of 1,900 sooner rather than later. That's all we have time for. Thanks for tuning in, and have a profitable week ahead. And good afternoon from Oanda, Asia. Well, what's been driving the market so far this week? Well, it's one word: inflation. So last week, the non-farm payrolls had a massive miss to the downside. Should have been almost deflationary, not inflationary, because less people coming into the workforce. But that was actually moved past very quickly. And this week, all we've heard and all we've seen price action-wise is concerns about inflation. Now, there's been a lot of noise this week and markets are chasing their tails back and forth, and it can be quite easy to get confused and wrapped up in that noise. But I think what we need to take out of this is the direction of travel for the markets. And the direction of travel, given that the non-farm payrolls was ignored so quickly, is that the markets are now concerned about rising inflation, be that because of supply chain constraints, semiconductors, rising commodities, rising food prices, labour shortages, wage expectations, yada, yada, yada. The direction of travel for the markets now is concerns about higher inflation. Now, we've seen some quite aggressive reactions in the market this week because of this, most notably in the equity space. And I think the reason we are seeing some of these choppy markets is because at the end of the day, we've had a 15-month bullish market from March 2020 last year in the depths of the COVID-19 pandemic shutdown, and it's gone one way without any material pullbacks that entire time. When we see markets like this, investors start getting very, very nervous at the top of these markets, and their propensity to hold even minor losses on pullbacks is very negative. And what we get is a lot of this toing and froing, choppy, fast money trading and some quite aggressive moves intraday. Having said that, though, there are some very interesting developments. And the first one I want to talk about is the NASDAQ, the tech-heavy NASDAQ. And it has actually finally broken out of its one-year uptrend line. This line you can see on the charts, it goes from bottom left to top right. It's in blue. It broke out of there at 13,400 on Monday. It also closed below its 100-day moving average. That's the little red line below it. And ever since then, it's struggled to reclaim that level. This is a very significant tech breakout. And when we think about the rally in technology stocks and the pimped up valuations that we're seeing around the world for them, markets are perhaps more vulnerable in that space to a pullback on higher interest rates / inflation concerns. My target for this pullback could extend all the way to 12,500, which is the little blue line halfway down, and that is the 200-day moving average. Quickly thinking about the S&P 500 and the Dow Jones, well, they're much more cyclical, heavy companies, and also more balanced. They're not so tech-heavy. They are still well and truly in bullish markets, and the markets would have to fall between 5 and 8% before they ended up testing the one-year support line that we can see on the NASDAQ chart. We saw some ructions today as we turn to Asia and Taiwan, where markets fell nearly 8% intraday, and we can see the TAIEX up on the screen now. We can see some quite aggressive price action there. COVID-19 has returned to Taiwan, and also Taiwan is the largest producer of semiconductors in the world, and we all know about the semiconductor issues. If COVID-19 community cases keep increasing in Taiwan, that could put potentially production strains on these Taiwanese semiconductor producers because of potential social movement restrictions. That is going to be felt all around the world and could be another knife in the back of the global supply chain squeeze, and it won't be good for tech stocks either. We can see here that it broke support at 16,850 yesterday, and it is now closing below the 100-day moving average, that red line on the chart, at 15,900. I haven't got a target for this, but we need to monitor the TAIEX very closely over the next few days. Okay, so what is going to spur these moments on tonight? Well, let's watch the US CPI. A high print there is probably going to see more equity weakness. Thanks very much for tuning in, and we'll speak again next week.
Well, thank you for this brilliant analysis of the market. We're going now to the global stock markets already. What we shall know to have a review on the Asian, European and American market.
Der Broker mit Flatrate. Unbegrenzt traden für 2,99 € im Monat als App und...
We're looking now at S&P 500 at the price that the prices are going up at this moment, and we will have a big correction timing during the next 2 weeks already. Nifty 50 is already moving ahead, stronger than expected already. And going back now to Nikkei, which is the only index market that had a positive side correction. Hang Seng has been already looking more downwards, and the Hang Seng index, China 50 index, started to decline at the beginning of the last week, 2 days before the FOMC meeting. What's a very important indicator. Going now
Der Broker mit Flatrate. Unbegrenzt traden für 2,99 € im Monat als App.
to the AX, the Netherlands indices that we have here a day range of 717 to 735. Good chance to jump into this market, and a favorite next is the Euro next. As we can see here, that the market has a clear downside trend, but with very strong corrections. Having a look on the market, and what you need to know is the steepening trade is dead for now already on one side, but on the other side, after the Fed looked the bond market on a roller coaster ride, the upcoming week is maybe all about getting more clarity over what it will take to get tapering started sooner. The 11 Fed speakers and the release of Fed's bank stress results will draw most of attention. On the other side, if we look on the European markets, for example, DAX 30 and especially
Der Broker mit Flatrate. Unbegrenzt traden für 2,99 € im Monat als App und im Web.
See here movement of DAX waiting for a correction already. We see that France holds regional elections on Sunday, held already last Sunday on June the 13th, with the second round of voting on June the 27th. It might be as next week. And the elections are a key test for President Emmanuel Macron ahead of the presidential vote in 2023. The Eurozone and Germany released already May flash PMI reports on Wednesday. Manufacturing remained bright stock with German manufacturing PMI that was expected at 64.4, and the Eurozone at 60.6, well into an expansionary territory. After the releasing the data, we have seen already that we had also in Europe a very weak flattering curve on these stock markets also. So people are taking back selling yields, and also at the same time the stocks to get cash because they are very frightened. The only market that has gained really high and made new high was Nasdaq Composite.
Der Broker mit Flatrate. Unbegrenzt traden für 2,99 € im Monat als App und im Web. Jetzt loslegen.
can see it here that it's coming back very strongly, and it may be related to some emerging markets like Czech Republic. The Czech Central Bank will announce a rate decision on Wednesday already, and the bank was expected to raise the repurchase rate at 25 basis points to 0.5% to curb rising inflation. Also, on Tuesday last week, Hungary Central Bank was expecting to raise its benchmark based on about 30 basis points, and the Asian emerging markets, the biggest one, India, and its COVID-19 case appear to be the right track as cases fell. What does it mean? It just means that a lot of big companies are removing their manufacturing from China. As we know, for example, the Samsung is moving from China to Poland and Czech Republic, and for a longer term, these markets could be really, really attractive to watch. Then we will have a look now.
Dividende, ganz was Feines. Da kriegst du in regelmäßigen Abständen deinen Anteil am Unternehmens.
On Cbo Volatility Index, which is increasing, and that's a fundamental, really important signal against the S&P 500. Currently, the index is rising again, but has a lot of troubles to make new highs. On the same time, the volatility index is increasing, so fundamentally it will make that we will have soon expecting a decline in S&P indices and related stock and shares market to S&P markets.
Good afternoon from Oanda, Asia. This is your weekly roundup of the financial markets and things that are catching my attention. And this week, my attention is almost entirely focused on the US non-farm payrolls on Friday evening. It will be the major data point of the week, and it's really going to give markets an idea of the pace of the US economic recovery. We saw a few blips earlier in the week. Factory orders, transport missed slightly. US ISM manufacturing PMIs, purchasing manufacturing indices also missed slightly. But otherwise, all the data is saying that the US recovery is on track. The missing part of that equation is employment, with 8.5 million Americans still out of work from pre-pandemic levels. So this evening, we actually have a sub data point, the ADP employment. That's also from the US. That is predicted to rise by about 800,000 jobs. It's often used as a predictor for the non-farm payrolls. Hasn't been that good of late. But if we do see an 800,000 print tonight, we may see US bond yields start to rise, and we may see more strength in the dollar. The dollar actually rose last night after Janet Yellen actually carelessly said that interest rates may have to rise in America to rein in the inflation from increased government spending. Tech stocks in particular took a hiding from this. And if we look around at technology stocks, actually, we look at the first chart that I'm seeing here today. It's the NASDAQ. And I guess out of all of the three indices, this is the one that's making me the most nervous and is perhaps the most vulnerable to a rise in interest rates on Friday if the US non-farm payrolls print above 1 million jobs. And that's the key number here. We can see that the NASDAQ is in a rising triangle. It has resistance around 14,100, just below market levels. and it has support at around 13,250. It's 100-day moving average in the base of that triangle. Now, if the Nasdaq was to close below there on Friday, that suggests that we've got another 1,000 points of downside. Now, tech stocks, as we know, are the biggest beneficiaries of the 2020 Zoom boom, and thus they are probably the most vulnerable to investor nerves such as their elevated levels. But if we look at the S&P and the Dow Jones, well, the picture isn't quite so nerve-wracking there. The S&P 500 is at all-time highs, but it does have more breathing space. It is around 4,200 at the moment, but it would really have to fall through 3,900, which is around its 100-day moving average, and also perhaps do some work around the 4,000 level for me to start getting nervous. So the two key supports there are 4,000 followed by 3,900, but it still has plenty of room to breathe. Similarly, the Dow Jones is at record highs, and it's beating up against resistance at around 34,300. But as we can see from the chart, it actually is still quite noticeably in a bull trend. And given that the Dow Jones is full of cyclical stocks, it is best placed to benefit from the US recovery. Cyclical industries have underperformed all over the world during the pandemic for obvious reasons, but they are very well placed to outperform if the global economic recovery continues at the pace that it is continuing at the moment. Finally, I want to talk about oil. I do like throwing a few curveballs in on my little ditties because we only have 5 minutes. Now, oil is behaving very interestingly this week. So on Monday, the dollar fell, but oil rallied. Yesterday, the dollar rallied, but oil rallied as well. So the oil market seems to have disconnected itself from the direction of the US dollar. And that tells me that the bullish momentum is building. And when we look at the WTI chart in particular, we can see that it is in a parallel upward channel. And a close above $66.50 a barrel says to me that oil, or WTI in particular, is going to target $71, and it might do so quite quickly. Well, that's all we have time for this week. Thanks very much for tuning in, and I wish you a profitable trading week ahead. And good afternoon from Oanda, Asia. Well, what's been driving the market so far this week? Well, it's one word: inflation. So last week, the non-farm payrolls had a massive miss to the downside. Should have been almost deflationary, not inflationary, because less people coming into the workforce. But that was actually moved past very quickly. And this week, all we've heard and all we've seen price action wise is concerns about inflation. Now, there's been a lot of noise this week and markets are chasing their tails back and forth. And it can be quite easy to get confused and wrapped up in that noise. But I think what we need to take out of this is the direction of travel for the markets. And the direction of travel, given that the non-farm payrolls was ignored so quickly, is that the markets are now concerned about rising inflation, be that because of supply chain constraints, semiconductors, rising commodities, rising food prices, labour shortages, wage expectations, yada, yada, yada. The direction of travel for the markets now is concerns about higher inflation. Now, we've seen some quite aggressive reactions in the market this week because of this, most notably in the equity space. And I think the reason we are seeing some of these choppy markets is because at the end of the day, we've had a 15-month bullish market from March 2020 last year in the depths of the COVID-19 pandemic shutdown, and it's gone one way without any material pullbacks that entire time. When we see markets like this, investors start getting very, very nervous at the top of these markets, and their propensity to hold even minor losses on pullbacks is very negative. And what we get is a lot of this toing and froing, choppy, fast money trading and some quite aggressive moves intraday. Having said that, though, there are some very interesting developments. And the first one I want to talk about is the NASDAQ, the tech-heavy NASDAQ. and it has actually finally broken out of its 1 year uptrend line. This line you can see on the charts, it goes from bottom left to top right. It's in blue. It broke out of there at 13,400 on Monday. It also closed below its 100 day moving average. That's the little red line below it. And ever since then, it's struggled to reclaim that level. This is a very significant tech breakout. And when we think about the rally in technology stocks and the pimped up valuations that we're seeing around the world for them, markets are perhaps more vulnerable in that space to a pullback on higher interest rates / inflation concerns. My target for this pullback could extend all the way to 12,500, which is the little blue line halfway down, and that is the 200-day moving average. Quickly thinking about the S&P 500 and the Dow Jones, well, they're much more cyclical, heavy companies, and also more balanced. They're not so tech heavy. They are still well and truly in bullish markets, and the markets would have to fall between 5 and 8% before they ended up testing the 1 year support line that we can see on the NASDAQ chart. We saw some ructions today as we turned to Asia and Taiwan, where markets fell nearly 8% intraday, and we can see the TAIEX up on the screen now. We can see some quite aggressive price action there. COVID-19 has returned to Taiwan, and also Taiwan is the largest producer of semiconductors in the world, and we all know about the semiconductor issues. If COVID-19 community cases keep increasing in Taiwan, that could put potentially production strains on these Taiwanese semiconductor producers because of potential social movement restrictions. That is going to be felt all around the world and could be another knife in the back of the global supply chain squeeze, and it won't be good for tech stocks either. We can see here that it broke support at 16,850 yesterday, and it is now closing below the 100-day moving average, that red line on the chart, at 15,900. I haven't got a target for this, but we need to monitor the TAIEX very closely over the next few days. Okay, so what is going to spur these moments on tonight? Well, let's watch the US CPI. A high print there is probably going to see more equity weakness. Thanks very much for tuning in, and we'll speak again next week. Hello everybody, I'm Jeffrey Halley. I'm the market analyst for Oanda out here in Asia. I am a Kiwi sitting in Jakarta, Indonesia, who normally would work in the Singapore office. But these are strange times, and if it sounds confusing to you, imagine how myself and human resources feel about it. I've been asked to give you a quick roundup of what is coming up in the markets in the month ahead. And actually it is a very interesting month, but thankfully most of the data releases that we are going to get are front loaded towards the start of the month. By the time that you watch this video, a few things may well have already happened that will be quite significant for markets. Firstly, tonight, and it is Friday the 28th of May at the moment, President Biden in the United States will have released his preliminary budget, where the Americans are looking to run a deficit of $1.8 trillion US, and that is after the tax increases that they want to push through in 2022. That is an awful lot of money for the government to borrow, and I want you to keep that in mind as we go through this chat, because this all circles back to inflation and interest rates and their effects on the world. The month starts off with a huge deluge of a data point we call the Purchasing Manager Indexes for manufacturing and services. The simple way of looking at it is it's an indicator of the direction of travel for the economy. And we're seeing these releases coming out from Asia, from Europe, and from the United States in the first week. Above 50 means that the economy is expanding, happy days. Below 50 means that it's contracting, boo. So we're expecting most of those PMIs to outperform next week as the global recovery continues to gather pace. There is some uncertainty around Asia though, because Ex-China, most of Asia is now grappling with new waves of COVID-19, and in some places such as Japan and particularly Malaysia, it is very, very serious. We're seeing lockdowns everywhere, and Singapore is also in a lockdown, which may have actually ended by the time you watch this video, but I rather suspect it's going to be extended. Sorry, my friends over in the Singapore office. Perhaps the week's or the month's data highlight will be Friday's non-farm payrolls. The first Friday of every month is always the US non-farm payrolls. It was a huge disappointment last month. It's around 200 and something thousand jobs when everybody, including myself, was looking for the Americans to add over 1 million jobs. Now, there's been a lot of talk in the markets about inflation, and is inflation coming back after 20 years, and if it does come back, is it sticky wage price Venezuelan inflation, or is it transitory inflation caused by supply chain disruptions, which should drop out of the CPIs over the course of the next year? I'm still in the latter camp. I don't know that inflation is returning yet after a 20-year vacation. However, if those non-farm payrolls don't add 700 to 1 million jobs this month, those inflation worries are going to subside dramatically, and the effect that we're probably going to see is that US bond yields will fall, and US bond yields are so important because they are the benchmark interest rates for the entire world ex-China. So indirectly or directly, if US interest rates go up, interest rates are probably going up everywhere except for Europe and China, and if US interest rates go down, vice versa. If we see a number around 700 to 1 million jobs, 700,000 to 1 million jobs added, this inflation trade will be back on track. That could be quite negative for equities. Remember, we've been in a buy everything rally since March 2020. I call it that because you could have bought anything but the US dollar and made money over the course of the following 15 months. Equities are at very, very rarefied levels, shall I say, right now, and they are, by that circumstance, vulnerable to potentially a quite aggressive pullback should the interest rate expectations take a swing to the top side for US interest rates themselves. And bear in mind also, the US government will be looking to borrow $1.8 trillion over the course of 2022, and that also will almost certainly push interest rates higher unless the Federal Reserve is going to continue quantitatively easing as aggressively as it has been. We have a number of central bank meetings this month as well. The first one is Australia next week. I'm expecting no change. And then the ECB follows the week after in the second week of June. Again, not expecting any changes there, but they may start signalling that they're talking about tapering their quantitative easing program. I very much doubt it though, because Europe is in a slightly different place to the US on their recovery track, and that was the case since the global financial crisis, in all honesty. The real important meeting this month will be the FOMC, the Federal Reserve meeting. That will come in the middle of the month, and all eyes will be on the FOMC statement. I expect no change in interest rates and no change in their QE program. What we're looking to see is if the Federal Reserve is formally starting to talking about tapering that quantitative easing and potentially a more clear path of when they are going to attempt to normalise rates. If they have blinked and they are starting to talk about that this month, again, that's probably going to be quite a strong headwind for equity markets. We're going to see the US yield curve steepen, i.e. longer dated bonds such as the 10 and 30 years will go up in yield. And we'll probably see the US dollar making a quite strong comeback as well, because higher interest rates usually equate to higher currencies in the ideal world of financial markets, something that we all look for but very, very rarely find. So June, I think, is going to be quite a crucial month for this year. I think we're going to have a much better idea about the direction of inflation and thus the direction of financial markets after June has been completed. We're going to have a much clearer idea of whether this huge equity or an asset market rally, asset price rally is going to continue, or whether we're going to start having a period of two-way price action, which is long overdue. And I would also note that one of my favorite asset classes, the crypto space, is probably not going to enjoy higher interest rates in the US either, so keep an eye out on Bitcoin. I don't think we've seen the last of the meltdowns there. Thanks very much for tuning in, and have a wonderful June. Cheerio.
Well, thank you. Also here, we have already a very interesting movements in stocks, especially in Russell, and also in water-intensive shares like Intel. And the question is why Intel stock dropped after its earnings beat. As you know, semiconductor giant Intel, which is in one of
Der
the
Broker
big
mit
movers,
Flatrate. Unbegrenzt traden für 2,99 € im Monat als App und
in Nasdaq bid on earnings last night, reporting 1.39 cents per share in pro forma profit in revenue. So what? Well, for one thing, also Intel beat estimates in the first quarter of 2021. Its numbers still went great, but revenue declined 1% year over year, and while pro forma profit was at 139 per share, when calculated according to generally already accepted accounting principles, the so-called GAAPs. At the same time, we need to know that semiconductors, for example, are really water-intensive markets. Global chemicals for water-intensive markets, but type, process, functional, and water treatment by application, for example, like pulp and paper, oil and gas, chemical processing, mining, municipals, and also other markets by region and key companies, industrial segment, outlook, market assessment, or competition scenario, trends, and so on. And you're gonna know a last report of Market US, that the report on chemicals for water-intensive market offers in-depth analysis on market trends, drivers, restraints, opportunities, and others. And along with qualitative information, this report include the quantitative analysis of various segments in terms of market share, in terms of growth, opportunity analysis, market value for the forecast years. So the global chemicals for water-intensive market is segmented on the basis of type, application, and also geography. Back again to Intel, for example, worse than that, Intel kind of took the wind out of its answers by pairing news of an earnings beat in the first quarter of this year with an earnings warning for the second quarter and also beyond. The management forecast that in second quarter sales will decline to about 80.9, let's say $19 billion, which is below Wall Street's estimates, and earning guidance for $1 per share likewise looks like to fall short for the street's projected $1 per share. Similarly, for the full year, Intel projected revenues will not exceed 77 billion, which appears to be slightly less than analysts were looking for. This is the reason why the prices fell. But on the other side, BlackRock industry is massively investing in Bitcoin mining. And they are now engaged in a project to build over 75,000 miners and minings in a secret project. And what do you need for all these miners? You need chips. You need Intel chips. You need mining chips. And who's producing that? Intel. So the reason is that Intel is also involved in that and investing massively in cryptocurrencies or the miners. And this is also the reason they are not going to give any higher dividends, but at the same time they are investing that money to be prepared for the near to middle future. This is the reason that now the stock market already dropped after its earning beat. So looking at the Dow Jones, we see here that Dow Jones also taken some profit sharing already. This is the 1 year already. We need now to go in 50 days, 20 in 2 weeks term, and we see we have a stabilization there. The 3 months overview is a decline of the price, and we have a high range of 33,622 to a lowest one 33,271 during the last year. Of course, yes, here the market is clear to see that we had a big trend up, and now for longer term the market has broken down the very important level of 33,000. So it is a massive short selling signal currently. How long it will take? Well, I can't say. Then if we look now at the S&P 500, we see that also here for longer term, S&P is increasing in a very good trend, but some way choppy and some way movement of big, really big volatility. The market, the trend is still long. It has not broken the major resistance. And we go again to NASDAQ, and we see here this is the daily, this is the monthly, and this is the 1 year, the last during the last years. We see that for long term the trend of NASDAQ is still long. So you can make now your decision based on technical analysis. And thank you for watching this live video. Stay tuned and have a good day.